Hello and welcome to Gemini Traders Update, your trusted resource for deep market insights and tactical investment strategies. I'm Zain, and today we are presenting our final comprehensive macroeconomic and investment strategy report for February 2025. In this episode, we'll dive into our detailed quantitative models, explain the underlying assumptions and methodologies, and provide a transparent look at our scenario and risk management processes. As The Economist recently noted, in these turbulent times, the transatlantic alliance is facing its worst nightmare, and global trade rules are under unprecedented strain. So let's get started. So, our podcast today lays out a balanced risk away strategy built on a blend of advanced quantitative tools and deep fundamental analysis. Central to our approach is a robust Monte Carlo simulation, a what if engine that runs 10,000 iterations to forecast key variables like US GDP growth, CPI inflation, that's the consumer price index measuring average price changes, Fed rate paths, AI revenue growth, and even Bitcoin sensitivity to ETF inflows. Now, based on these assumptions, our baseline forecast shows a median US GDP growth of 1.7% and CPI inflation centered at 3.1%, with a range from 2.6% to 3.7%. These numbers are supported by data from the Bureau of Labor Statistics, the BEA, and Federal Reserve Communications. Many experts, including those at Barron's, are bullish on AI's long-term potential, yet they caution that high price-to-earnings ratios and slowing growth may eventually trigger a market correction. Historical parallels, such as the tech bubble of the early 2000s, reminds us that when growth decelerates, high valuations are typically adjusted. As one Barron's headline aptly noted, time to break up Comcast. However, these warnings are important. Some critics mistakenly interpret them as reasons to abandon tech investments entirely, overlooking the robust fundamentals of companies like Microsoft and Alphabet. Practically, take away monitor these drivers weekly. Knowing the assumptions behind these forecasts help you interpret market signals as they evolve. So now let's talk about global macroeconomic and geopolitical environment. Now, on the global stage, trade wars continue to reshape supply chains, forcing companies to shift production from China to emerging markets like Mexico, India, and Vietnam, backed by reports from WTO and government trade data. This realignment can boost domestic manufacturing, but rising production costs may squeeze margins. Tariffs targeting aluminum imports to the US, for instance, it has buyers scrambling to procure the metal before kicks in. A stark reminder of how cost pressures can persist long after initial disruptions. As noted by the Wall Street Journal, for example, the tariffs imposed on steel and aluminum in 2018, it led to a noticeable cost pressures and supply chain disruptions that many manufacturers are still grappling with today. We face two possibilities: rapid tech driven adoption, or more likely, protracted disruptions and cost escalation. Inflation remains a mixed picture in this scenario. While CPI readings hover between 3% to 3.3%, different sectors are experiencing it very differently. For example, shelter inflation is up by 4.8% year over year, driven by housing shortages affecting consumer spending and mortgage rates, and pushing investors towards alternative stores of value. When traditional assets face inflationary pressures, safe havens like gold and even volatile assets such as Bitcoin can become attractive hedges. Now, about let's talk about service inflations now. It is up by 4.9% year over year, as post-pandemic demands still remains high, and good inflation is down by 1.2% year over year, thanks to improved supply chains. This divergence illustrates that not every part of the economy responds uniformly to inflation, necessitating a tailored, nuanced approach. The Sunday Times highlights how retailers and suppliers are reacting differently, while some critics overlook these overlook these facts by treating inflation as a monolithic force. On a geopolitical front, recent US Russia talks, criticized by The Guardian for excluding Ukrainian voices, and rising European defense spending, as noted by The Washington Post, suggest um, that despite claim these risks are overstated, the exclusion of critical perspectives and continued policy shifts echo historical episodes like the 2014 Ukraine crisis, while simultaneously posing direct economic consequences such as potential energy supply disruptions that could drive inflation higher and slow economic growth. Additionally, key insights from the Washington Post further enrich our global overlook. For example, Pentagon shakeup, Trump's purge of top military officials, including the fire of Joint Chief Staff General Charles Brown Jr. and Chief of Naval Operation Admiral Lisa. It has thrust the Pentagon into uncharted territory, raising national security concern among retired generals and legal experts. The removal of top military figures creates uncertainty about national security strategy. For a trader, this may translate into increased volatility in defense related equities. Technology firms focus on security, and companies that rely heavily on stable government contracts. The potential for heightened risk premiums suggests that hedging defense sector exposure and exploring safe haven assets could be prudent while monitoring shifts in government policy that might affect capital allocation. Federal workforce turmoil, aggressive directives from Elon Musk services, including emails demanding detailed weekly activity reports, have generated significant anxiety among federal workers, with fears that non-responsive might be interpreted as resignation. The aggressive management directives causing unrest among federal employees signal operational instability within key government agencies. This type of internal disruption can spill over into broader market sentiment, potentially impacting sectors tied to regulatory decisions or government contracting. As a trader, consider diversifying into assets known for stability or low correlation with domestic policy shifts and remain agile with regular portfolio reviews to adjust for rising uncertainties in government operations. And if you talk about Ukraine policy uncertainty, it is shifting. There are there's a shifting stances on Ukraine, such as blaming President Zelensky and demanding concessions like Ukraine's mineral wealth. It have deepened diplomatic rifts and created uncertainty for both U.S. foreign policy and Ukrainian security. The evolving inconsistent stance on Ukraine, including contentious demands and diplomatic pressure, it introduces geopolitical risk that can disrupt not only defense-related sectors but also global commodity markets, especially in energy and raw materials. Heightened uncertainty in Eastern Europe may compel a reassessment of exposure in related commodities, and multinational firms with concentrated supply chains. Traders should keep an eye on geopolitical risk indicators and be prepared to adjust positions rapidly if tension further escalates or softens. If we talk about cybersecurity and data privacy, a federal judge order preventing Dodge from accessing sensitive treasury data underscores the critical importance of safeguarding personal and financial information in an era of heightened cyber risks. A federal judicial order restricting access to sensitive treasury data underscores a broader regulatory push to secure digital information. This heightened enforcement environment can induce short-term volatility in technology and financial sectors as companies adapt to tighter compliance standards. Traders they might consider monitoring earning reports for cybersecurity related expenditures and adjustments, potentially favoring firms with robust digital risk management practices while keeping risk mitigants in place in sectors that face regulatory headwinds. Implication for international alliances, these internal shakeups and controversial foreign policy maneuvers, it signals potentially long-term shifts in the US alliances and global diplomatic dynamics, stressing the need of policymakers to reassess strategic partnerships, internal shakeups, and divergent foreign policy signals hint at potential long-term shifts in the US and their alliances and global trade dynamics. Now, for a trader, this suggests that market correlations could shift and internationally and internally expose might need revaluation. Keeping balanced exposure in diversified global ETFs or multinational could help manage the risk abrupt changes in global strategic partnerships. Now, such realignments may also present opportunities in regions or sectors less affected by US policy volatility. Furthermore, let's consider some additional high profile insight reported by the Times that enriches our global outlook. Now, Apple's UK data security shift. Apple has removed its advanced data protection tool for British customers in response to government evidence collection orders, reflecting new legal powers and a major push by UK authorities for access to encrypted data impact on privacy and international relations. This decision could further strain relations between UK and the US, triggering potential political fallout as tech firms assert their commitment to user privacy, and it underscores the broader global debate over data security and the role of government in regulating tech companies. The decision not only underscores a fundamental tension between user privacy and government oversight, but it may also strain diplomatic ties, especially between the US and the UK. This potential diplomatic fallout carries important implications for investor sentiment. If Rose's Atlantic relations deteriorate, traders could see uncertainty spill over into broader market risk, particularly affecting multinational tech companies. Heightened political risk might prompt investors to seek out safer assets, trigger increased hedging activity, or lead a reallocation of capital away from sectors perceived as vulnerable to sudden regulatory shifts. And for a trader, this development serves as an early warning that regulatory shift can force even the most robust technological companies to alter their product strategies in response to state mandates. Such abrupt adjustments have the potential to induce short-term volatility in tech stocks and may lead to a reassessment of risk premiums attached to firms that rely on strong data encryption as a competitive advantage. These developments collectively highlight an environment where regulatory, geopolitical, and security issues are interdependent. For a trader, the takeaway is clear: maintain vigilance for signs of heightened volatility. Consider tactical hedges when risk indicators intensify, and rebalances your portfolio frequently, as suggested on a weekly basis, to remain aligned and evolve with evolving risk. In these conditions, diversification, agility, and a robust risk management framework become essential tools for navigating uncertain markets. What you can do is stay alert to these factors and rebalance your portfolio weekly. Defensive adjustments may be necessary if trade or geopolitical risk intensifies. And let's talk about our next segment, which is about quantitative analysis, detailed Monte Carlo correlation insights. So let's dive deeper into the numbers, shall we? Our comprehensive 10,000 iteration of Monte Carlo simulation models US GDP growth and CPI inflation with normal distributions, capturing ranges from 0.8% to 2.2% for GDP and 2.6% to 3.7% for inflation, and the Fed rate path with the normal distribution centering around 4.75%, but potentially swinging between 3.5 and 5.5%. Our dual method correlation analysis using both fixed and rolling windows reveals strong linkages such as a 0.70 to 0.72 correlation between the Nasdaq 100 and Bitcoin, possibly driven by institutional flows and shared risk sentiments, and and an inverse correlation of about negative 0.5% to negative 0.45% between gold and equities, and now that reflects its safe haven role during downturns. Moreover, by incorporating an estimated 22% CAGR in AI revenue growth for tech giants like Microsoft and Alphabet, along with the insights such as each $1 billion in ETFs, it inflows boosting Bitcoin's price by roughly 1.5%. Our analysis not only assigns scenario probabilities. For instance, our 52% chance that inflation stays above 3.5% until quarter four, and a 34% likelihood of an AI correction, prompting overweighting of market leaders over stocks like Nvidia, but also emphasizes the practical takeaway of regularly reviewing both fixed and rolling windows correlation to fine-tune diversification and hedging strategies in a dynamic economic environment. So practical takeaway is regularly view both fixed and rolling windows correlation and consider AI revenue growth as a critical factor when evaluating tech investments. So our next segment is about asset-specific analysis, valuation metrics, and robust evidence. So let's turn our analysis into actionable recommendations. Let's start with Bitcoin. Now, as reported by the Wall Street Journal, the regulatory environment for Bitcoin is easing, evidenced by the SEC's recent decision to drop its lawsuit against Coinbase, which makes a significant shift in oversight that could boost investor confidence. Supporting this positive development, our research indicates that for every $1 billion in ETF inflows, Bitcoin's price historically rise by about 1.5%. However, Bitcoin valuation is influenced by the confluence of factors. Not only do inflows play a role, but evolving regulatory policies, technological advancements such as improvement in blockchain scalability, and increased network activity, reflected in rising active addresses and higher transaction volumes, also contribute. As the economist notes, in an environment of uncertainty, the market carefully weighs these multiple influencing factors before reacting sharply. So, trade recommendation for Bitcoin is take an entry from 90,000 to 95,000. Your target should be 110,000 to 115,000, and your stop loss should be about 8 to 10%, uh, 8 to 10% of your total capital at max. Practical takeaway is monitor ETF inflows data together with regulatory and technological updates to adjust your exposure accordingly. AI and technology stocks, we quantify overvalued tech stock using specific thresholds. Stock with PE ratios above 30 or PS ratio above 10, combined with revenue growth below 15%, may be considered overvalued relative to industry norms. Companies like Microsoft and Alphabet typically trade at more moderate numbers, reflecting their sustainable earnings and growth prospects. Um, our strategic positioning for these are on Microsoft. We will be overweighting Microsoft and Alphabet, and our underweight stocks that exceed these thresholds. Practical takeaway is using these concrete metrics in your quarterly earning reviews to spot rebalancing opportunities. Defensive assets, gold and US treasures. Gold is a traditional hedge, while US Treasuries offer stability, particularly in a rising rate environment. Trade recommendations for gold are you can take a long entry from 2,900 to 2,950 and target 3,100 to $3,150. Your stop loss should be around 200 at $2,850. That is $2,850. Now, practical takeaway employ these assets as a counterbalance during market volatility and review their performance weekly because this is swing trade and make sure and our stop loss is quite deep, so make sure you open a position that your account can accommodate. So let's just talk about a little about ATR. Now, ATR or average to range measures the volatility of a stock by considering the price fluctuations over a period. We use ATR to set stop loss levels that accommodate normal price movement, thereby inducing the risk of premature exits. So let's not the next. Let's talk about our next segment, which is portfolio construction and balancing alternative investments and risk. Now, building a resilient portfolio is essential. Here's our approach: diversification across asset classes. Beyond our core assets, consider real estate investment specific REITs, such as residential REITs for steady rental income or commercial REITs focused on office and retail properties. Commodities ETF tracking specific sectors like precious metals, gold and silver, industrial metals, copper, and energy commodities like crude oil. International equities broaden exposure with international ETFs. Emerging market ETFs can capture growth in developing regions, while developed market ETFs provide stability and diversification. If you talk about risk tolerance and allocation, you need to align your asset allocation with your risk profile. I'll go again for whatever your risk appetite is. That's how you plan it. Aggressive investors might favor growth assets like tech and Bitcoin, whereas conservative investors may allocate more to defensive holdings like gold and treasures and REITs and diversified international equities. Position sizing and contingency planning. Use volatility measures like ATR to determine position sizes and cap the risk of any asset to no more than 15% of your total portfolio risk. For contingency planning, if a benchmark indexes fall sharply, consider reducing risk position by 20%, reevaluating your overall risk profile, and potentially increase your allocation to defensive assets. Utilize an automatic dashboard to monitor performance and rebalance holding on a weekly to be a monthly basis, while on updated economic data and shift in asset correlation. Practical in the way is construct a diversified portfolio that reflects your market outlook and risk tolerance, adjusting allocation dynamically as conditions evolve. Final execution plan and comprehensive risk management. Let's consolidate our key positions into a final execution plan. Let's start with gold. Gold remains the traditional hedge against inflation and uncertainty. US Treasuries add stability, and alternatives like select REITs and commodity ETFs further diversify risk. For example, residential REIT such as Avalon Bay Communities and commodity ETFs like in Westco DB Commodity Index Tracking Fund. Sorry about that. Which also goes by the name of DBC, are valued tools in turbulent times. For example, the entry should be between 29 to 29.50. Target will be 3100, 3150, and stop loss is going to be 2850. Now, rational, a reliable hedge against inflation and geopolitical risks. Bitcoin is shaped. Let's talk about Bitcoin. It is shaped by complex factors, including on-chain activity, ETFs inflows, and regulatory developments. While historical data indicates that of $1 billion ETFs inflow might correlate with roughly a 1.5% price increase, regulatory uncertainty remains a major risk. We can take an entry from 90 to 95,000, target 10 to 11, targets are 110,000 to 115,000, and stop losses are 85,000. Now, rationale driven by ETF inflows trend, increasing active addresses and higher transaction volume, while also closely monitoring regulatory and technological developments. If we talk about AI and technological stocks, valuation remains key. We assess these techs with metrics such as PE and PS ratio. A stock trading at a PE ratio more than 50% move its industry average might be considered overvalued unless its growth prospects are exceptional. Companies like Microsoft and Alphabet, with sustainable AI revenue growth and moderate valuation multiples, they are offered, while stocks that fail to justify their high premiums may be de-emphasized. So for Nasdaq quarter to quarter ETF, my entry will be from 400 to 410 and target with 375 to 380. Stop loss will be 420. Now, adjust exposure in overvalued tech sectors if monetary policy remains tight. For Microsoft, entry will be 400 to 410, target will be 460 to 480 dollars, and stop loss will be 385. Because we are looking for some solid fundamentals, moderate valuation multiples, and strong AI-driven revenue growth. U.S. Treasuries TLT ETFs starting price entry price is 90 to 92, target is 98 to 100, and stop loss is 80 at US dollars. Because this provides stability and as a safe and serves as a safe haven in a high rate environment. Beyond stop orders, guys, we determine position size in using volatility measures and cap risk per asset to fixed percentage of the portfolio. Our contingency plan not only involves reducing high risk positions by 20% if a benchmark index falls sharply, but also reevaluating the overall risk profile and increasing allocation to defensive assets than assets when needed. We can maintain an automatic dashboard for retail, um, daily tracking, and conduct throughout portfolio reviews on a weekly and monthly basis. So our next segment is about conclusion. It's our final segment, our final verdict and transparency on methodologies. So let's wrap up with a reminder. While global power dynamics and trade policies remain unpredictable, the future will reward those who prepare with both agility and resilience. As highlighted by recent market commentary in both the Economist and Barron's, our final comprehensive macroeconomic and investment strategy report for today offers a robust, data-driven roadmap grounded in rigorous Monte Carlo simulations using normal, log normal, and even T distributions, detailed correlation analysis, and transparent valuation metrics that not only empowers you to seize growth opportunities through actionable trade triggers and alternative investment like residential and commercial targeted commodity ETFs and international equities, but also balance and contingency planning, and also by advocating for constant vigilance through daily economic indicator reviews and regular portfolio rebalancing. Our comprehensive approach underscores the need to stay agile in an uncertain global development. Now, remember to consult a licensed financial broker before making any decision, and don't forget to subscribe for exclusive risk management resources and a complete and a complimentary ebook upon launch on navigating geopolitical risk in investing. Take care of yourself, trade safe, and I'll see you guys